Okay, well, very good then. So I'm going to go ahead and turn this over to Alex and Logan. They've got a PowerPoint for us. They've got a spreadsheet model for us. We're going to go ahead and post these to Canvas sometime after our discussion today, just as we'll post the video as well. Okay.
Perfect. We good to go?
We are good to go. The time is yours,
Awesome.
gentlemen.
Oh, Rick, it says you've disabled screen sharing. Would you mind turning that on for us?
Okay, well, that's interesting. Let's see how I might do that. I didn't know I disabled it. Okay, does that help you?
Yep, now we're all set. Perfect.
Very good.
Awesome. Let me just throw this in the presentation mode. All right, so it's referred to as Black-Scholes, Black-Scholes. We're going to try to refer to it as Black-Scholes today. And so Black-Scholes, what it deals with is option pricing. So I'm not sure how many of you really are aware of what options are. I'm kind of assuming you guys have a general background, but just to get started, so what is Black-Scholes? Black-Scholes is a model for pricing options. And that being said, it's usually done for European options, but it can also be done to US options. And the reason it's ran for European options is European options can only be exercised upon the day that they are expired, versus the options we have here in the US can be exercised at any point. So for simplicity and the way pricing works with Black-Scholes, it's a little bit simpler if we just refer to it in regards with pricing it in the European stock market and model. So, but it is applied to the US. So it was developed in 1973 by Fisher Black and Myron Scholes. And then later, Robert Merton, I believe is how you say his name. I could be wrong. He ended up writing a paper that helped prove the evidence of Black-Scholes and how it works in the financial market. So that being said, Merton and Scholes, they received a Nobel Prize back in '97, but Fisher Black had already passed away. So to get into it a little bit, so options are derivatives based on the value of their underlying asset. In this case, it's the stock at hand, and that'll be the case with each of your firms when it comes to the Black-Scholes assignment. So moving forward, it's an option to contract that allows for the person who owns that option to either buy the underlying stock when it's a call option or sell at a specific price with a put option, and that's designated within a specific time frame. One really unique thing about options is you do not have to buy or sell the stock if you own the option. You just own the right to possibly buy or sell. And then the last point just summarizes where I talked about a little bit before, how Europeans can only be exercised on that day they expire, whereas American options can be exercised at any time before. So when we're pricing an option, we look at it as a European option with this model. So coming back, there's option pricing that occurs in the marketplace, which is used by traders or hedge funds to hedge their positions. But coming back, since we're in a valuation class, an important question is, why does the Black-Scholes, or how does the Black-Scholes influence what we do here in this class and in the valuation field? So the importance of Black-Scholes in the valuation field is, so we're dealing with, as maybe some of us have had in our case studies this far, the employees get granted a stock option. And when employees are granted a stock option, it is seen as a taxable event because they're getting some type of bonus of payment or an aspect in that regard. So they're a taxable event, but when that occurs, a lot of the time when this happens in the private sector, we don't know the exact value of the stock options that are issued or the exact value of the firm at that moment. So when this happens, where it comes in regards with the valuation field is, so once those are issued, since they're a taxable event, a value has to be found for the stock options. And that's what Black-Scholes allows us to do, is it allows us to motivate a value of the option price, which is issued. So that's what's used in your case and will be used moving forward. And the way this is done is, so the first aspect of valuation that we hit on when we're doing this Black-Scholes model is we're trying to find the option price per share. So first, to even get to per share, we have to then find the firm value, which could be done through a multiple and an income-based approach. And once that firm's value is identified, we then take the value and we find the firm's equity. And then once we have the firm's equity, we can then find the value per share. And then we'll use that information compiled with some more information we're going to talk about here in a second to find the current price of the option. Are there any questions? I know that's it's a different aspect than we've ever kind of thought about option pricing this far. Does anyone have a question? Rick, anything?
Could you walk back through briefly the difference between the European and American way that we think about option, and help us put that in perspective with us, please?
Yeah, just give me one sec. Okay, so if we go back, a big difference between European and American, just to touch base before we run down each avenue. European options, the way they work is you have the option to buy that underlying stock or sell, but you cannot do that till the expiration date. So, that might be April 15th, and that's the one day you can only exercise that option, compared to in the U.S., when we have an option and we own it now, that being March 31st, it expires April 15th. Well, I can exercise that option at any point up until it expires. So from now until April 15th, I can decide to exercise that option. So in that regard, that's where they differ a little. And then if we were to move over to, in the case of a firm, let's say, we're looking at this in a European perspective, the stock options aren't able to be tapped into or issued for, let's say, a year. So the entire time that's going on, the stock options you can't exercise the option you have. So in a year from today, March 31st of 2021, you could decide to exercise that stock option, and that's the only day you could in the European model. Now, if we switch over to the US model, and let's say that same stock option type deal, it expires in a year on March 31st of 2021, you have the ability in the US, with the way options run, to exercise that at any point. So you could exercise it here in 3 months, in 6 months, or even on the last day, the year. So in that aspect, it's the same when it comes to that very last day, but the U.S. has all the time in between. Does that answer the question you had, Rick?
Well, it does, and I didn't so much have the question. I just wanted to kind of rehearse that again to make sure that people captured it. Here's a question I have, though. So if sitting here in the U.S., I am given some stock options. I can exercise them anytime between, let's say, the end of this year and 5 years. With the Black-Scholes option pricing model, it only gives me a price based upon if I exercise at the end of that 5 years. But I'm sitting here in the U.S., and I can exercise this thing anytime during that's like a 4 or 5 year window.
Right.
Why would the model not be adjusted or modified to recognize valuation for American stock options?
That's a good question.
Well, that's why I asked it.
So So one thing I can think of just moving forward to the way the formula works. So it has a relationship to do with the fact that we assume that no dividends are paid, or if they are paid, they're not paid until the option expires. So in that aspect, I think that's a possible reason as to why. I can't say that I have the exact answer to your question at this point. That's going to have to be something I think about a little bit later and maybe come back and touch upon, just because I haven't really thought about that route that could go. But in that aspect, I think the goal is, while we're trying to find the value of an option and the way it's pricing, if we did do this on a day-to-day basis or at any point in an option value, it would be so, I feel like, not complicated, but you'd have to have so much information all the time that it would be really, really difficult, because we could have a firm value, let's say a month ago, and then all of a sudden, here we are a month later. Well, now we're in a completely different economic state than we were. So in that aspect, I think another part of it is we can't exactly guess where the markets are going to go. So we're trying to give it our best guess at this point.
No, you're exactly right, Logan. You're exactly right. So what you guys are about to see from Logan and Alex is a model that they have crafted in such a way that it's not going to seem all that complicated to you. But behind this, there's a lot of statistical complexity. And it's all focused on a valuation based on being able to exercise at a particular day. When they show this to you, I want you guys to try to imagine the sheer enormity of the complex task if we had to think about the plausibility or possibility of exercise over 3 years times 365 days, so over 1,000 different potential dates. Right? And that's the issue, Logan. So it's not just the issue of this market volatility in the interim, although there's some relevance to that. But it's also the issue of we have individuals making decisions in the midst of that. And whenever you put human beings into a decision-making process, the complexity goes up exponentially. That's why.
Right.
So think about this when they're showing you this model, guys. And I'm going to ask another question that might even be a little clearer once we get to the model.
Are there any other questions on this slide or in regards with the valuation field from anyone? No? Okay. So if we move on to the next part. So this is the formula that breaks down Black-Scholes. So it looks very, very complicated, and there's a lot of math behind the scenes that go into it. That being said, when you break it down into each individual aspect, it's really not as complicated as we might think. The main thing with Black-Scholes is most of the inputs that are going to go into this model are actually observed. So they're obtained, the strike price is given to us, what it can be issued at. We find the current stock price. We know when the option expires, and then we know the current risk-free interest rate of the marketplace that we're looking at. The one item that we don't know that's estimated based off historical information is the volatility of the stock, and that comes from the standard deviation of the stock returns. It's the standard deviation of the natural log of the stock returns would be the more complicated aspect. That being said, there's no need to kind of freak out and panic that this is a formula that's crazy complicated. So if we bounce over here to the right side of my screen, the model where the formula is put in. So what we're really going for here is we're trying to find out the call premium. We're trying to find out that price of the option, like we said before, because we need to know, what's the amount of tax that needs to get paid on that option when issued to a firm, like the case that we're studying. So going into the actual side of the formula, you can see that S in this first part, that's equal to the current stock price. Now we have N times D1, and N is the cumulative standard normal distribution of D1. So that's where a little bit more math buried into this equation, because then we have to bounce down here to D1, and we see it's the natural log of the current stock price divided by the option striking price plus the risk-free interest rate. That's then added to the standard deviation of stock returns squared, and then that's divided by 2, which is then times by time until option expiration.
Logan?
And yeah.
You're making my ears bleed.
Okay, we'll just kind of, so this is, to break it down, this is the formula if you were going to get really into Black-Scholes that you're going to use. You guys, the way the model's built, you won't need to know exactly all the complicated math that goes into this. You just kind of have to understand what aspect makes up what. So whether it's the stock price, the time until expiration, the option striking price, or the risk-free interest rate, that's kind of the information you guys need to know. We have in the model, the volatility is calculated for you when you put in all your inputs. So if you want to dive more into Black-Scholes, what I'm saying is this is the math behind it. So you can dive into this if you want. If not, you don't have to, because the way the model we built is set up. Any questions there? Simplifying it down? No? Okay. So there are some assumptions we make when we're using Black-Scholes, and that is one, like I talked about earlier, that the stock being valued pays no dividends, or if it does, it's not until expiration. The stock can only be exercised upon expiration, which we touched on before, just based on the fact that we don't want to run 1,000 different data points to get information. We can't predict the market direction. There's no commissions charged on the transaction of when that option is exercised. And the interest rate's going to remain constant, and stock returns are normally distributed, which means the volatility is fairly constant over time. Now, on the flip side, with there being assumptions and the way Black-Scholes runs, there's also some limitations. So one, we're also assuming that the risk-free rate and the stock volatility are going to be pretty constant. They're going to remain constant. We're also going to assume that stock prices are continuous and that no large changes in prices occur. So the large changes in prices that could occur would be like a merger or acquisition. So let's say, like in the current state of the economy, with how COVID-19 is affecting everything, well, one sector that's struggled a lot is the cruise line industry. So the cruise line industry is left out of the $2 trillion stimulus package that's been put in place by the U.S. government. Well, with that, you have firms like Carnival, Princess Cruise Lines, you have Royal Caribbean, but Royal Caribbean's the only firm that has a large amount of cash flow due to a credit line. So if they were to buy Carnival, you would see a merger take place, and that's when you would see a large change in price occur. So we're assuming that no mergers or acquisitions are going to occur within this time frame when we're finding that option price. We also, like I said earlier, the stock doesn't pay a dividend during the time frame we're valuing it. And then one of the other things is the model tends to overvalue deep out of the money calls and undervalue deep in the money calls. So with all that information being said, we're going to now switch over to Alex. Alex will take control of the screen, and we're going to work through and kind of look at the Excel model we've built for you guys.
Let's see. All right. Everyone see my screen now?
Yep.
Yep. Okay. Logan did most of the hard work. I just get to walk through the model. So this is the really simplified version. The only inputs you're putting in are your current stock price, the strike price, and then this volatility is calculated, which I'll go into on the other tab. Your risk-free interest rate, time, which we just have set up at a year right now, and then the dividend yield, which, like Logan said, we're assuming is going to be 0 for this. And then all it does, it calculates this D1 and D2 for you, so you don't have to do that complicated calculation, and then it just gives you the value of either a call or a put option. And then if you go into the expanded version, we just have a few more columns showing some different variables. So in these first three, we have the time set at 6 months, and then the increasing exercise price. So you have $50, $60, $65 on the exercise price, with everything else remaining constant, and you can see how the value of the calls and puts change. And the intrinsic value is just the difference between the stock price and the exercise price, as you can see there. And then you have the speculative premium, which goes up with more time because it has more time to reach that higher price. And so over here, we now have, we keep the same exercise price of 55, and we go from a time of 3 months up to 3 years. And you can see how the value increases when you go up to 3 years versus just the 3 months. And so now the volatility calculations, we just, I actually did this for Warrior Manufacturing. So you just take all of the equity values and throw them in, and you take the log price. All you're doing is the natural log of this year divided by the previous year. And if you were to do the percent change, it's actually pretty similar. If you were to do the percent change of this divided by that, you're actually going to get almost the same, yeah, about that same 10%. But it's just, this is the standard way of doing it. You take the natural log, and then to get the volatility, all you're doing is the standard deviations of these natural logs, and then that's your volatility.
Yeah, so the beautiful thing of this model is you really don't have to change much. When it comes to that volatility screen, all you're going to have to do is put in your stock prices. You might have to change the Excel area that's being, put into your volatility. But you really won't have to do any of the complicated math due to the Excel model already being built for you, and everything else being, built in there with the complicated math. So it's really cool because it's a really simple way, it breaks down a really complicated thing into something simple. Just going back to the expanded real quick, whenever you're referring to time, like Alex has the time to expiration, if you're always dividing the number of days until the option expires by 365. That's one really important thing to note. Just if you were going to look at something that's not exactly a year or 2 years or 3 years, just because that does change your parameters a little bit. So that's just something I wanted to touch on there. And you might notice that there's, under these columns of information, there's these calls with the delta, gamma, theta, vega, rho. Well, what those are really referring to is those are breaking down. They're almost like little sensitivity. They show how sensitive the stock you're looking at is in respect to each one of those areas. So delta and gamma reflect the current stock price, how the option value changes with the current stock price. Theta focuses on the stock's, sensitivity to time and how that affects price. Vega does the same thing with respect to the volatility, and then rho is the same thing in respect to risk-free rate. So those are more complicated things. You don't have to know those, but just wanted to touch base so you guys have an idea there. But you can see, like Alex said, there's those call option values. So in the case of a firm we're looking at, when you're issued a stock that's worth currently $7, but you can't exercise it till 10, or it doesn't, the exercise price is 10, you're not going to exercise it until it's above the exercise price because it's just not worth it. It's out of the money. So that being said, that's why we have to find those call option values, is so that the employee can pay taxes on those. That bonus they can be issued through stock options. Is there anything else you wanted to touch on, Alex?
No, I think that pretty much sums it up.
There is one opposite side that you won't necessarily have to deal with in valuation most likely, and that would be the put option side of a stock. And so with the put, you're saying you can sell it at that certain price. One way this could happen is, let's say Alex and I own a very small, investment firm or some type of firm that we specialized in, and we have a potential investor that's looking at investing with us. However, that being said, he doesn't want to invest in case the investment goes south. He doesn't want to lose all his money. So what we might do as founders of the company, or the people who created the company, we might provide him or issue him a put option that allows him to sell back the shares of the company that he receives when he invests to us at a designated price, in case Alex and I somehow all of a sudden tank our company. So that's one way the put options can be used. However, that's something we don't really have to deal with for the cases we're looking at, and what you'll generally motivate using Black-Scholes. Are there any questions? Anything seem like it was kind of flown through that you might want to review again? Anything in regards to that aspect?
So I'm going to ask Alex that you put the simplified version up on the screen for a moment.
Mm-hmm.
And in a couple of minutes, I'm going to ask us to play with this some so we can see what some of the different variables are doing here, because there's a relevance to some of these, and I want to make sure that you guys understand them, which also means I want to make sure you understand your ability to manipulate them and what the manipulations mean. But before we do that, it's interesting, Logan, you talked to us about where a put option might be relevant. So, and I think you gave the example of, if I'm loaning money to your company, I'm a little less than confident that I'm going to get this back. Then you give me a put option so that I can put it back to you effectively. Now,
Right.
I bought loan money to come back. I bought stock rather than loan it, but
Right.
I'm not all that warm and fuzzy about it. So I'm saying, hey, okay, fine. If this doesn't work out, I get the right to put it back to you. So you're right. That's a utility of a put option within the valuation world we might deal with. That probably would be seen in venture capital more than any place else, right?
Right.
Why would we not issue put options to our trusted employees?
Yeah.
What's the whole
So
purpose of this?
that gets really, the whole purpose of when you're issuing these call options. So on the flip side of a put, we're trying to align the employees' vision, their goals, their visions for the firm with ours. So the reason they're out of the money is because we want them to have the same perspective as the management, as the owner or the management team who's issuing them, because we want the company to grow and increase its value. On the flip side, if we were to issue these puts to our employees, well, all of a sudden now our employees are motivated to go tank the value of our company, because they're going to make more money if our company's worth less, because they now have these options to sell the stock at a higher price if they tank the value of a firm. So that's where you would avoid, that's the case why puts are usually avoided being put to employees. But on the opposite side, the main focus is we're using calls here because we want to align the employees' values and their goals for the firm with what the actual firm's goals are, because we want to increase value. So when that value increases, the stock prices increase, and then all of a sudden their options become worth money. Does that answer your question, Rick?
Well, it does, and I want to make sure that you guys have understood what he said. Britton, can you kind of parrot back to us the rationale here, just to make sure that everybody understands?
Yeah. So giving your employees an option to sell the stock at a price that would be assuming the price is lower than the current price would motivate them to decrease the value of the firm, because they stand to gain money in that instance, and it would not motivate them to increase the value of the firm.
Exactly, and that's what Logan just said to us, of course. So I can't think of a single instance where I've ever seen a put option granted to an employee because of that misalignment of interest, right? In fact, it would be tantamount to encouraging our employees to go out and sell the company short, which is a disaster for us as the other stakeholders. Let's look now at this at some of the various variables in here and kind of challenge what they're doing. So Alex, I see the risk-free rate here, and you've got it in at 4%, and that's fine for the moment. You don't need to make a change there. But why do we have a risk-free rate, or for that matter, any rate built into this model? What does the U.S. Treasury bond rate today, which could be a risk-free rate, what does that have to do with the value of an option?
Right. So I think that comes back to the fact that these option prices are derivative of stocks that are under them. So anytime you're investing money, there's the opportunity cost of what else you could have invested or used your money for. So in regards to the option price, well, the risk-free rate is if I go, let's say buy a bond from the federal government, which is essentially never defaulted in history for the most part, that's the amount of return I'm going to get in 1 year. So I would say we have to build that in because there's that opportunity cost of money. And that's the same thing with investing in stocks. And an option is derived from the value of a stock. So you still have the return on your money, which could occur.
So you're telling me that behind this whole model structure, there is a time value of money consideration, right?
Correct.
And you're right. So why would we use a risk-free rate rather than, here I've got Kira, she's my investment advisor. She's never caused me to venture into an investment that's returned less than 12% in our lives. So why on earth would I go ahead and use a risk-free rate?
Couldn't the risk-free rate be kind of indicative of expectations in the market as well?
Yes, but do me a favor for a moment, Alex. Recognize, guys, that the value of this call option when using 4% rate, the value is 4.41. Alex, would you please change that risk-free rate to 2.3%? And notice that the value of the call option has fallen. Okay, well, that makes sense to us, but it gives us a sense of where in the equation the risk-free rate's utilized. So when the rate got smaller, the value went down. That would suggest that the risk-free rate's used in the numerator of the equation rather than the denominator. Okay, I'm not sure what that does for me. What do you say though we think about, could we substitute the risk-free rate for our own discount rate?
I mean, I would think you could. It's going to change the value, but you could. So if we were to throw it up to a higher number.
So I just said that Kira has never returned less than 12% to me in her life. So let's plug this in at 12 points. And we go from $4 to $6.50. That's not a trivial move. Well, but then neither was 2.3% to 12%, right? It's not a trivial move. This is extraordinarily sensitive to that rate. And I've seen talks given and arguments with respect to what that rate should be. Should it be a risk-free rate? Should it be a discount rate? Should it be an industry average rate? I mean, we're thinking now through the elements of RE, right, and the CAPM model. Or, because this is specific to the company's common equity, because that's the only thing you're really going to see options on in practical terms, should it be RE? Well, that's interesting. Let's think about changing time now. We have this stock option set for an exercise in 1 year. We know that most options, certainly those that are granted to us by companies, are exercisable over a period of years. You probably realize that an option that you might buy in the open market probably has a trigger or a date set within the next 90 to 120 days. It's unusual for options to be very lengthy in the open market. But in this case, we would expect this number to be 1 year, 3 years, 5 years even. So would you go ahead and return the risk-free rate back to your 4%? So we get back to your standard at, I think it was $4.41 in value for the option. And now let's move this time out to 5 years. So it appears to be extraordinarily sensitive to time as well. Why would it be so sensitive to time, other than time value of money considerations?
Because you have a much longer window that you can, well, I guess we're using the European model, so that would not make sense. I was going to say you'd have like a longer amount of time to, like, you have more of a chance to hit that price that you'd be in the money the longer it's drawn out.
Well, and what you're saying in different terms is, if we have a longer time frame, the probability of volatility normalizing on a standard is greater.
Right.
Okay. Mm-hmm. If we move that thing out to 20 years, and you don't need to do that, Alex, but if you move that out to 20 years, you're going to see that as well. In fact, as we move beyond that, every additional year doesn't give us as much of a change as those first few years, because we're converging on some normalcy and some lesser volatilities here. So here we have this set up under the European construct, but here we're sitting in the US. How might we model then a strike price, or how might we model the value if I come to you and say, well, I know that I can exercise this anywhere from today to 5 years from now, but I expect to exercise it in 3 years. Well, what we can do is we can simply change the time to 3 years, because that it expires in 5 years or whenever is important in the European sense, but that's no less important than when I might expect to exercise it if it's here in the U.S. Because once I've exercised it, it may as well have expired. I can't exercise it again, right?
Right.
So think about that some. Let's also do a change here. So take that back to 1, please, so we can get back to your 4.41. And let's look at the sensitivity with respect to the change in strike price. So we got the strike price here at 55. So this is $3 out of the money. Okay. What if we put it at 52? So we're dead even. Well, that's interesting to me. Why is it that if the stock's currently at 52 and the strike price is at 52, so I'm even with the market, why do I have a meaningful value of 5.78 in this call option? Why would I ever pay to buy something at the price I could buy it at today?
Is it because within the next year or on the date that option is supposed to expire, you're almost, you would think the volatility, to some degree, the way the stock moves, there's a possibility that the value of the stock goes up. So if I own that option today, and why today it might not be worth it, let's say all of a sudden, in a year the stock's worth $60. Is that, that's what I feel like is why that call price gets driven up.
No, you're exactly right. Alex, would you move us to look at your volatility worksheet, please? Notice here that there is not trivial volatility in the price of the stock. In the year 2000, it was valued at 2,000. It's almost steadily declines all the way to $800 in 2008. So it was bucking some of the market trend during part of this time, and then it fell prey to the market trend, and then it brought us back up nicely here to 2018 to 24.40. This is not a trivial range for this price, for the stock to trade in. I mean, that's more than 100% movement. So, and you would say, well, in the years that we've been assessing market activity, if we look at the dot-com bubble that was developing for the year 2000, we then look at the financial crisis of 2007, 8, 9, and then see how the markets have run up, that this is not an unusual pattern for us, right? All that we're really recognizing is that we've had substantial volatility in our markets. And so we're seeing the effect of that within this model and the effect of the stock prices. Let's go back to your simple model just for one more change, Alex, if you don't mind. And let's take this back to, let's take it to the stock price of, let's do it at 52, but let's put the strike price in at 48. So we're $4 in the money. And notice that being in the money, exactly as we might expect, adds yet more value to the option than being even with the money. Okay, you can play this out so you can identify at what point the option has virtually no value. The only way you're going to get used to what this model does is to play with it some. So I'm going to encourage each of you to do that, and you know you have an assignment to do that within your respective cases. What other questions or comments would you have for these guys?
I mean, I would say just if, Alex, if you don't mind hurrying clicking back on that expanded tab. If you look, so we're talking about how each of these different items that are changed, you know, how sensitive they are. Well, that's where those Greek symbols come in. They show you how, and that's more shown on the expanded, they show you how each one of those particular items affects and how sensitive that specific option price is to that. So that's kind of a more in-depth way to look at what causes what. Just because, like, if you look at this left side, the 6 months increasing exercise price, well, you see the delta changes, which means the option price is going to change a little bit more, a little bit less based on the current parameters. So that's kind of like, I feel like the more deep in-depth look of how those affect each option price.
Well, in fact, the same kind of sensitivity analysis that I just looked at, one change at a time in your simplified worksheet, you effectively have that modeled out for us with seemingly greater complexity, but you have it in a comparative fashion,
right.
Column by column. And the reason I wanted to do it in this kind of a sequence is to show you that you can either make a change at a time, look at it, consider what it means, or you can allow a variety of changes to take place at once and then see them on a comparative basis.
Right.
Okay, very good. Any of the rest of you have questions for Alex or Logan with respect to this?
With the Greek symbols, so a negative number would mean it's resilient to a change in that specific category?
Yeah, so, and I think that's one, I mean, Britton, I'm not a rocket scientist on these Greek symbols. I just understand the basic, meaning of what they are. But that being said, going on what you're saying, I think it makes a degree of sense, right? So theta, that deals with time. So, let's say time decreases, well, we just have to logically think through, if time decreases, how's that going to make the option worth value, which we can then play with by toying around with the model a little bit more. That being said, I'm not a rocket scientist. I'll look into it more for you to get you the answer, but I don't have that exact answer at this moment.
And just so the rest of you will know, that these different sensitivity factors in the different symbols, like Logan, I have a very basic understanding of them, but I don't even know what they're really, each one of them necessarily representing. I think that if we were to spend a little bit more time developing this model, I would perhaps get rid of columns D, E, and F, and then H, I, and J. So I just put the 3 columns of numbers together and let the descriptors over on the left-hand side serve for each one of the columns, right? And then I might go ahead also then and do a little table somewhere here to help me see what each one of these symbols, delta, gamma, theta, what they're actually representing and what a positive or negative change would mean. I'm not telling you guys you actually necessarily have to do that, but if you're ambitious and bored and want to end, Alex or Logan, you want to do that, that might be a very useful tool. Okay. Well, nicely done. Nicely done. This is the second most complicated of the forms we're going to deal with.